Title of my talk today is Silver is the New Silver. Now, that's a little bit tongue-in-cheek, but the reason I went with that was because silver is known to be volatile, up and down, but can be tremendously strong on the upside and can take a lot of people by surprise. And when it does that, I think until we start to really see that happen, which I think is starting to happen now, I think people forget, and so that's why I think you can view silver as being silver once again. Just to give you a quick summary of what it's done in the past year and a half. So it bottomed at the end of February of last year, $22. We're at 46 as of yesterday. It's over 105% gain. And then if you want to get a little leverage, you can look at junior silver stocks, and they're up 183% from that same point in time. And typically you'd expect at least a 2-for-1. I think that's coming. I think we're going to see a lot more than 2-for-1 silver stocks versus silver. So it's looking like it's going to be a lot more fun. Just switching very quickly to a little bit of macro. What drives silver? Well, certainly silver is both industrial and monetary. So there's the monetary side of what drives silver, and inflation is certainly a big one of those drivers. And I like to use this data that comes from University of Michigan. They do surveys regularly, and they look at what consumers expect for inflation to be going forward. So we know inflation is at 3%, and consumers just a few months ago were expecting 6.5% a year out. Now they're still expecting 4.8%. That's very elevated. Nearly, we're getting close to double of what actual or reported inflation is. So if you have consumers with these kinds of high inflation level expectations, they're going to act accordingly. And I think that's one of the reasons we're starting to see silver move so much as well. Here's a quick look at inflation pre and post COVID. So you can see on the left, that green line shows you the average of inflation. And I remember quite well, I don't know if some of you remember, but the Fed was desperate to get inflation up to 2%. It was averaging about 1.5% for nearly a decade. And they were keeping rates at near zero, financial repression for a long time, just to try and get things kickstarted, and nothing was working. Well, COVID came along and changed all of that, and that blue dotted line right there, that vertical line, is when COVID essentially hit. And then you see inflation taking off. We had worldwide coordinated printing. Inflation took off, went to 9% in July of 2022, and then has dialed back as they raised rates, and things kind of, opened up and fell back into place. But we're still averaging 3% over the last couple of years, which is double what we had pre-COVID. So it's no wonder people are expecting inflation levels to stay elevated. And again, we're starting to see that, I think, work its way into the silver price. So, I've been saying for about a year that the trigger will be when you see the Fed start to cut rates in the face of high and or rising inflation. And I think that's really what we have now. So I think this is really what indicates sort of the trigger for a big run. You've got the Fed that has decided that it's stuck between a rock and a hard place and made the choice of supporting the economy versus supporting the dollar. You have, over the last couple of years, about 2 million jobs have been revised away. The jobs or the employment picture is gradually worsening in the U.S. They're just paying lip service to their 2% inflation target. Obviously, we're at 3%, and they keep talking about that we're going back to 2%. They haven't been able to make that happen in any way, or realistic way at all. But there's some clear advantages to cutting rates. Helps the government refinance their massive 37 or whatever it is trillion dollar debt. They can pay less interest on it. We know Trump wants a weaker dollar. That helps to boost exports. It also makes imports more expensive, so it pushes consumers to buy from locally, internally produced things and services. They can't do that for everything, of course, because they don't produce everything in the U.S., but so that will help to feed inflation as well, because The imports that have to happen, and now on top of it, with tariffs imposed, are more expensive. So people will have to pay more for things. So as I say, we're heading, I believe, towards negative real rates. The Fed is cutting. We know that that's kind of a magic indicator, so to speak, for precious metals bull markets. When you have inflation above what interest rates are, that takes away the opportunity cost of owning precious metals. And as I said at the beginning of this slide, about a year ago, I was saying when you start to see central banks cut rates in the face of high and rising inflation, that's when all bets are off. And they've basically admitted to you that they can't control this thing. The cat's out of the bag, and precious metals are essentially on their way from that point. I'm going to go off on what might sound like a little bit of a tangent here because it's not directly related, but bear with me. This is not something that you hear very much about in mainstream media right now, but you have obviously heard about cryptocurrency. There's this thing called stablecoin, stable coins. There are several, and what their intention is to be a crypto that replaces everyday currency, like the U.S. dollar, for example. And the advantages are that it's easily transferred. It's you can transact pretty easily with it. So this largest one is called Tether, and it's worth $100 billion. And most of Tether is backed by U.S. Treasury bills. But what is very interesting is that the CEO of Tether has recently announced that they're starting to shift some of their assets towards what they call tangible assets. 5% of Tether's assets have gone into physical gold. They recently bought a large stake of Elemental Altus Royalties, a gold royalty company. After that, Elemental announced that it was merging with EMX Royalty, which many of you may know. They've been at these conferences before and have presented many times. So now they've merged into a new company. And with that transaction, Tether announced that they would end up being a 33% shareholder of the combined company, and they're going to invest $100 million into this newly merged company for them to go out and buy more royalties, gold royalties. So what's happening? Why is the largest cryptocurrency stablecoin that's meant to mirror the US dollar looking at going into tangible assets, and not even just physical? Maybe they feel they can't get enough physical, but into something like royalties, which is really quite impressive. Naturally, royalties are not as flat or stable as the dollar. I'm not going to go into that too much, but their purpose is to have a predictable price level, like the dollar, like a dollar per day, for example, a dollar each day, all the time for that coin. And yet they're going into things that have some volatility. And anyways, all of that to say that for me, what that means is that they see the writing on the wall. Our monetary system is going towards things that are tangible. Gold and silver have been money for 5,000 years. And they're giving you a clue to where they certainly see things headed. So let's go and start talking about silver right now. Why would you want to invest in silver? Well, I'm going to focus on what I think is the biggest demand driver on the industrial side, and I think that still remains solar, and there's some things happening there that are pretty interesting. So this shows you the International Energy Agency's World Economic Outlook and how pathetic their predictions have been for solar installations versus actual installations. And if you look through the 2010s, solar deployment beat their 5-year forward forecasts by 200%. That means that through the 2010s, solar installations going out 5 years were 3 times the size or the level of what they had predicted. So yes, of course, we've seen huge rollouts of solar. Is it possible it will slow down? I believe so. It's certainly possible, but from elevated levels. And slowing down doesn't mean it's not continuing. It just means the growth rate is slowing down, but you still have tremendous growth. And here's what may be changing that and keeping these sustained high levels in solar rollout. Data center power demand over the next 4 years is expected to grow at 21%. The AI which is the big thing right now, of course, for many good reasons, is expected to see a 33% annual growth in electricity demand over the next 4 years. So data centers and AI are going to really be powering a lot of power growth over the next 4 years at least. Now, I've shown this slide before and I got some pushback. Some people said, you don't have baseload power and solar power, and I'm going to speak to that in a moment. But this chart shows how tech giants have favored solar over wind, nuclear, and some other options, versus wind 3-to-1 versus nuclear almost 5-to-1. And my argument was that although it was not considered baseload power, it's a lot cheaper. It's fast to permit. You can be totally independent. You can have your own solar farm right next to you where your data center is if you have the room for it, and you're up and running in. The chart on the right shows you solar is up in less than a year and a half. Nuclear is up and running and providing power in 15 years. So we know that the big tech companies, some of them have tapped into nuclear, but that was really unused nuclear capacity. And that is essentially gone, so they have to look at other options. Now, why is solar going to remain an option for them? I think battery is the new story behind solar. The levelized cost of battery storage in 2024, from 2024 to 2035 over the next decade, is going to drop by half. And already this year, it's expected that the battery installations are going to reach 60% of solar capacity installed in 2023. So battery is really catching up and keeping up with solar power installations. And that's what is going to change the game for solar, I believe, and convert it from being a variable source of power to a baseload power. And I think that will make it a lot more attractive yet to all sorts of applications, but certainly AI and data centers. Switching gears a little bit and looking at dependency on silver. Silver, after oil, is the commodity with the single most applications worldwide. So silver, when you say silver is indispensable, it's replaceable in some ways, but as I say, it has so many applications that if silver were to disappear tomorrow, it would wreak havoc on a lot of industry. The U.S. imports 43% of all of the silver that it consumes or requires every year. Bigger picture, if you look at silver versus stocks, relatively, silver peaked in, say, early 80s, bottomed versus the S&P in 2001, peaked in an obvious way in 2011. And if you look at where we are right now, it certainly looks like we're in a bottoming process once again, and that things are looking like they're ready to take off. Certainly the last year has started to make believers out of a few people. Central banks. Now, this is small, but it's indicative of what's starting to happen. The Saudi central bank just recently announced that it had bought $40 million of the SLV ETF, as well as combined with this Global X Silver ETF. So they're not just buying silver through an ETF, but they're buying silver miners through an ETF. A year ago, the Russian central bank said that it was going to start buying silver for its reserves in the 2025 to 2027 period. I've heard different numbers about what that might be, but it could be as much as $500 million worth of silver. And so it begs the question, who's next and who may already be buying that it just doesn't want to say because they want to influence prices and they may be looking at it as a strategic move. So here we're going to look at the gold to silver ratio, which is quite helpful sometimes. A great chart by Incrementum. And so the green line in that chart shows you the average since 2000, which was about 69 or so. The average going back to 1970 was about 60. And the average going back to 1900 was about 52. So if you take $3,700 gold today and you use the average going back to 2000, that puts you already at $54 silver. So we're beyond that all-time high of silver, potentially pretty easily, just based on that ratio. And that would mean gold, remember, that means gold staying at 3,700. I don't expect that to happen either. So the more gold goes up, even if the ratio comes down, the harder it is for silver to keep up. So if the ratio does come down, that means silver is moving even more and even faster than gold is. This is a little bit of a busy chart, but again, bear with me. So this goes back to the late mid-80s or so. And what it tells you is that roughly when the gold-silver ratio peaks around 80, a couple of times, 3 times since then, it's gone above, markedly above 100 around 1980, 85, 88 or so. And then again during COVID, I peaked at an all-time high of 125 and then at 120 again, about 110 or so again just recently. So when you see that, it suggests that it's time for silver to start catching up. But the best way to kind of look at this is if it's above 80, when it starts to trend downwards, and especially when it crosses through 80 and keeps going down, then you really have sort of the firing pistol to buy silver versus gold, at least, and that it'll rise more quickly. So keep in mind the low in 2011 in this ratio was 30, and in 1980 it was 15. So if we go more conservatively and we take, again, today's, say, $3,700 gold and a 55 to 1 ratio, which I think is pretty reasonable if you look over the last, say, 30 years or so, somewhere around here, 55 or so, that puts you at $67 silver, a 52% gain from where silver is right now. Actually, so this is an incrementum chart. I actually came up with that myself, and they decided to make their own version of it. But what it was the idea was to look at how silver behaves when you get Fed rate cutting cycles. And what I noticed was that the silver price tends to bottom when the rate cutting cycle is about halfway done. We saw that in the early 2000s. We saw it in 2008 and again in 2020. And if you take the average of bottom, so trough to peak in the silver price as of about halfway through the rate cutting cycle, silver in the last 3 cycles averaged about a 332% gain. If you look at where we are now, the Fed started cutting about a year ago, then paused, has just started cutting again. In my view, we have just sort of passed that halfway point in the Fed rate cutting cycle. And although silver did start to run earlier this time, it points to a lot of potential upside. If you take the low from 2024, which is, I feel, more fair, when silver bottomed at $22 or so in late February last year, a 332% gain brings you to $95 silver in this cycle. I really think that that could be 12, 18, 24 months out, but I think it's really looking like a serious possibility. People are coming back into the silver space. The SLV ETF is the largest silver ETF globally. Here you saw that it was draining silver all that time. There's different reasons. I've talked about that before, but it bottomed in the middle of last year, and you see people starting to buy that ETF again. I think you've got investors coming back into the silver space. So why would you want silver stocks? I'm going to have to go a little quickly now. The silver mining industry is tiny. So silver mining industry, again, for different reasons, is only about $18 billion. The gold mining industry is $702 billion. Silver mining is only 2.5% the size of the gold mining industry. When money starts to flow into the silver stocks, the impact can be really massive. If you take the bottom, essentially, of the last year and a half, so late February last year, silver's up 105%. Silver stocks, juniors, are up 183%. That is so far. This is a great chart from a good friend, Jordan Roy Byrne, who mapped out the analogs of the previous junior silver cycles over the last 20, 25 years or so. And if you look at where we are now versus the strongest one, which was quite compact, 2004 to 2007, we could still be up 4x from where we are now in junior silver stocks to match that 3-year bull cycle. So quite compelling. If you look at the junior silver stocks versus the silver price, so that ratio, so far, in the 2020 rally, silver was up 140%. This SILJ was up 200%. Not quite the same leverage, but in the 2016, which is the rally that we see right here, where that ratio just exploded, silver was up 45% in a matter of about 7 months. The SILJ was up 348%. That's almost an 8 times leverage in a matter of 8 months. So that gives you some idea of how explosive this sector can be. So to kind of wrap things up, some of you may know I've partnered with Jeff Clark of the Gold Advisor. He writes the Pay Dirt Prospector. I write Silver Stock Investor. It's the only silver-focused investment newsletter. And inflation is here for us too. It's been 4 years for me with Silver Stock Investor. Prices have been the same. We've decided that we're now going to raise prices. It's probably going to happen in the next sort of week or two, but anybody who gets in now gets to be grandfathered. And as long as you are a consistent subscriber, that your subscription does not stop, then you get to lock in the current prices as long as you stay subscribed. To sum things up, in Silver Stock Investor, in just this year so far, 9 months in, we've taken profits on 7 companies that have doubled. And I think it's still very, very early days. I think there's a lot of upside left. If you want to know more, go to silverstockinvestor.com. And thank you very much for listening.